Good morning and welcome to Almus Market Mornings, your daily dose of global financial updates with me, Swaraj. Indian CPI was out yesterday, printed a number higher than what the market expected, and in similar lines to what JK has been mentioning just a few days back. The much awaited US CPI was also out yesterday, and one could guess how the numbers fared against expectations by just looking at the market reaction. Equities rallied, Euro USD breached 1.11, which is a technical level, and a broad based dollar decline. What's interesting is the large declines in CPI is also coming from a fall in energy prices. Good morning, JK. Just two questions for you. Does the Indian CPI affect RBI's stance? And on the US front, do you think the recent rise in oil prices can trigger higher CPI prints going forward?
Good morning, Swaraj. I'll come to your questions eventually. So it was a tale of two different retail inflation numbers yesterday. First, it was the Indian CPI and then the US CPI. Let me deal with the US CPI. It was a year-on-year rate which trimmed to 3%, from an expectation of 3.1%. And this was not a surprise, as basic advantage was anyway expected. But the big positive surprise came from core CPI that broke yields lower and the stocks higher. Core CPI, unrounded and at three decimals, it came to 0.158 versus, what was expected at 0.3%. And also the year-on-year substantially came down to 4.8 from 5.3% in May. And expectation was for a 5% number. In the golden details, core CPI services ex-shelter printed just 0.91% from 0.161%, 0.091% from 0.161%, big change. And I've been hinting in the last 2 days about the big fall in the wholesale old car sale prices, and this has had a definite impact on these. And some of the alternate core measures that are shown, like Cleveland's Fed trimmed mean 3-month annualized running at 3.2%, has also substantially come down, with even core coming down to 1.4%. Now, Treasuries had a massive rally that witnessed yields tumble as many as 8 BPs for 30-year, 18 for 2-year, low at 4.715. It's really 50 BP down from the high seen on the day of ADP report less than a week ago. And then benchmark 10-year yield closed down 12 BPs at 3.86%, after dropping 24 BPs from the high. The benchmark 2 over 10-year yield curve has steepened and disinverted by 83 basis points from over 92 basis points. The belief that Fed may go for an actual pause and not a skip after a July rate hike actually ignited the rally in bond stocks and the risk currencies. Fed members did not, of course, overreact to the data and were guarded on their reactions going forward, while market still discounts more than 90% chance of a hike in July, which the popular whisper column for Wall Street Journal also confirms. The recent rising trend in crude oil prices after Saudi and Russia cut outputs should put some caution in getting too carried away. Now, stocks surprisingly reacted higher, but gave up some gains towards the close, with the earnings report keeping some caution in traders' minds. Even so, S&P 500 ended 0.75% higher, and Nasdaq more than 1%. The all-country composite index rose 1.01%. UK, the best performer, at 1.83%, followed by Europe at 1.72%. The good sentiment has promptly spilled over to the Asian markets, with only Japan, being an exception because of the strong yen. The news from CPI in US obviously overshadowed the Bank of Canada decision to hike the rate by 0.25% to 5%. And it remains on a watch, while New Zealand held steady at 5.5% after 12 consecutive hikes. Now, there may be more good news on inflation print when PPI data is released, and that is expected to cool as well. PPI measures were already softer than CPI. Producers have already suffered more directly from monetary tightening, as well as the switching patterns of consumption away from goods. As we know, services inflation has been contributing a lot to the overall number. So factory survey shows that price pressures have continued to ease in June. Now, on Forex, yields falling much less in other countries, and expectation of Fed rate peaking earlier than others expressed itself into dollar weakness across the board. Euro with the maximum weightage in dollar index charged nearly 1% higher and resulted in dollar index breaking previous bottom at 100.80, actually a double bottom. Some stop loss selling of dollars kicked in on that. GBP is still holding around 1.30, possibly on an option barrier, but break targets 1.32. While Euro has an immediate target at 1.1180 and 1.1250. Slight overbought conditions on the short-term charts may be a hindrance to swifter rally from these levels. Target for dollar index after breaking double bottom comes at 98, with only the psychological level of 100 standing in the way. The feature of the latest weakness in dollar is the secular move higher in almost all the currencies, particularly the yen and the yuan, who were till recently very weak. With its move to 138.20 yesterday, yen has gained nearly 5% from the recent peak, while yuan has been stronger by nearly 1.8%. EMs benefited further due to fall in US yields. Mexican peso, who has been the darling of carry trades, hit an 8-year high, while Swiss franc, which has long served as a safe haven and now carries a reasonable yield as well, hits a 9-year high against the dollar. Gold recovered nearly 1.5%, but more gains are possible in the coming up sessions. Now, coming back to India, India has been in a world of its own. The easing trend in Indian inflation turned around, with June CPI showing a rise to 4.81 from a revised 4.31% in May, with a huge rise in food inflation to 4.49% and a less supportive base effect contributing to it. The rise has happened after 4 consecutive months of moderating inflation. The erratic rainfall has been the cause behind this big rise in food inflation. Of slight concern, even core inflation remained between 5.1 and 5.4% versus 5.02% in May. Pushback on rate cuts, even as some researchers projecting CPI to hit 5.2% again, but pause should continue. So coming to your question, RBI stance will continue to be one of pause, because we are still below 5% as far as the inflation is concerned. If we do start moving towards 5.5%, then we could see some more tightening stance, but that is not foreseen right now. But we need to be cautious because of the recent rise in crude oil prices, with Brent moving above 80 now. The headline inflation might actually start to go up, and also we need to keep an eye on the progress of the monsoon. We are only midway through the monsoon season, not even midway actually, and if there is a vagaries of monsoon, can actually put our economy into a more tricky situation. Of course, on the rupee, I don't see a big impact on the rupee from domestic inflation, as rate implication is not seen right now. Rupee impact may be more due to US inflation falling, particularly on the forward premiums. We could see the Indian yields remaining elevated even as US yields have plummeted. And this would take 1 year forward premium probably above 1 rupee 45 paisa, or 1.76% versus 1.53% seen recently. Spot USD has moderately strengthened to 82 in the India market, but no follow-through has been seen, notwithstanding the Asian giants like yen and yuan strengthening. And market remains skeptical about renewed actions from RBI to build a wall of resistance for the rupee ahead of 81.70. On a relative basis, Chinese yuan, which is the big influence on rupee, is still quite weaker versus the rupee on a 6-monthly basis. That should prompt the central bank to maintain the recent ranges for the time being. This will change towards the downside only if we see a large accumulated flow. That's something that we need to wait and see. Higher carry may attract more selling from exporters on any up to 82.20. All in all, a very busy session in New York, and possibly one in the European session as well today, until we get more data from US on the inflation and growth front. Thank you.
Thank you, JK. And just to quickly summarize the themes, there was a substantial decline in the inflation figures which was printed. Core CPI, which came at Y on Y 4.8% versus the 5% expected. So basically, a drop in inflation figures all across Y on Y, MOM, and everything, because of which we saw a drop in the US yields, almost 18 basis points for the US 2-year yield, and which I mean, substantial. Sort of changes the stance for the Fed, not for the July meeting, but for the later meetings. The rise in oil prices can put some caution into the inflation figures. Something which got buried under the news was, of course, the Bank of Canada decisions, which decided to hike rates by 25 basis. India continues to be in a world of its own. Post 4 consecutive moderations, we are seeing some rise in inflation, but as of now, it seems RBI's stance to be on pause will continue. INR, of course, strengthened due to a broad dollar weakness, and the fallen yields can also lead to some rise in forward premiums. That's it from us today. Thanks for tuning in, and we look forward to catching up with you tomorrow with another round of fresh updates. Thank you.